Welcome to Wealth Conversations with Biztech. Today we explore the topic of investing during uncertain times and we speak to the World Gold Council. Now here to give us his insights is Andrew Naylor, the Regional CEO at the World Gold Council. Now Andrew, welcome to the show.
Thank you, it's great to join you, Brian.
Now Andrew, before we start, could you give us a quick overview of what the World Gold Council actually does?
Well, the World Gold Council, we are an association of the world's leading gold mines. So they represent our membership, or make up our membership. But the function of the World Gold Council is to develop the global gold markets. And we do that across all different areas of gold demand, which I'll talk about a bit later. But some of the things that we do, we provide research, data and insights to help people understand the role of gold as an asset class, but also to understand the contribution that the broader gold industry is making in terms of economic development, in terms of helping to combat the effects of climate change and so on. So there's a lot of work on information provision and increasing understanding. But complementing that, we do a lot of other work in terms of market infrastructure support. So we've worked in India, for example, to support the creation of a bullion exchange there. We worked here in Singapore many years ago on the development of Singapore's market, and we've done that in different markets around the world. And then finally, we also set standards and have an ESG program as well. So some of the standards that we set apply to the gold producers. So we recently launched the Responsible Gold Mining Principles, which are a set of principles that define what responsible gold mining looks like, but it helps investors and market participants navigate the gold market and understand the efforts that are being made to improve and to operate at the highest levels of ESG compliance. We also have other principles and standards as well. We have something called the Retail Gold Investment Principles, which are a set of principles designed to increase trust and transparency for consumers of gold. So these apply to not the gold producers, but the product providers, so the retail market that actually selling gold to consumers, either through traditional shops, for example, but also more prominently now through online methods and through digital gold accounts and so on. So we have quite a broad remit. But really bringing all that together, our role is to improve the functioning of the global gold market and make sure that gold remains relevant in the international financial system going forward.
Okay, and I think I want to take you up on that key point on gold remaining relevant. How has the use of gold changed in the last 2 decades? And how has that impacted consumption patterns of physical gold?
That's a very interesting question. I mean, first of all, let's have a look at where demand for gold comes from. And there are 4 major sources. So you have investment demand, which is around about 42–43% of annual demand. So that's basically investment in bars and coins. It could be retail investment, or it could be big institutions, pension funds, big institutional investors, some of the banks, for example, buying or allocating to gold bars, either directly or through physical gold ETFs. So that's investment demand. That accounts, as I said, for, on average, and if you look at the when I say average, I'm looking at the 10-year rolling average, but it's around about 42–43% of annual demand. Around about a third of demand is jewellery demand, and that is global, but the majority of jewellery demand comes from here in Asia. So if you look at demand overall, about 74% of annual demand comes from Asia, and it's no surprise that China and India account for the bulk of that, particularly when it comes to jewellery. So that's jewellery. You also have central bank demand. So gold is obviously used as a major reserve asset. Central banks, certainly over the last 10 years, on average, have been net buyers of gold, and there was a bit of selling at the height of the COVID crisis last year, but we're now in a net buying position. So central banks are still accumulating gold on a net basis. They account on average for around about 17% of annual demand. And then the rest, which is about 7–8%, is technology demand. So gold is used in lots of different areas. And we've actually just released at the World Gold Council a series of mini documentaries looking at different aspects of gold, one of which is gold's use in technology, in particular its use in space technology. But it's often used in very high-end technologies because of its lack of corrosive properties. So when you have sort of safety critical technologies, like in the medical industry, for example, or in very high-end electronics, where safety is absolutely paramount, often gold is used because of its lack of corrosive properties. It has a number of other chemical properties as well, which are very appealing in many technologies. So that's just one of them. And it's also very conductive, for example. So you often find it's used in very, very high-end technologies. It's used in medicine, in testing kits, for example. It's often found there. And there's a lot of research taking place at the moment as well into gold's use in nanoparticulate form, which is very, very interesting because the applications for this are often in environmentally friendly technologies. There's a lot of work and research being undertaken to look at gold's role in fuel cells, for example, in carbon capture and storage systems. So there's a really sort of interesting potential role for gold in the new economy, in the environmentally friendly technology sector, for example. So to summarize, it's used quite broadly, and that actually makes it very unique because there isn't an asset really like it that has that demand profile. Because of that uniqueness of demand, that's really why gold behaves quite differently from other financial assets. But in terms of the changes that have taken place over the last 2 decades, there's 2 things I would point to. And it's really to do with gold's dual nature. And by dual nature, I mean you have retail demand and you also have investment demand or institutional investment demand. And both of those are very different drivers. And I'll talk about that in a minute. When it comes to retail demand, which is jewellery in its bar and coin demand, the biggest single driver of that over the last couple of decades has been rising incomes, in particular in China and India. So as people have had more money to spend, as incomes have grown, as disposable incomes have grown, we have seen an uptick in gold demand.
And Andrew, that's also a cultural thing, isn't it? Because China and India historically have always looked at, and this is going back decades, just gold as a store of value and hedge against inflation.
That's right. Yes, I mean there's a long historical association with gold in many markets, but in particular in India and China. There are other markets as well that have a very, very strong historical connection to gold. Turkey is another example. You also see in some other markets in Asia, I'm based in Singapore, but close to here, you've seen a long affinity for gold in Thailand, for example, and in Vietnam. And similarly in India and China. So that underpinning that rise in demand that's been driven by primarily by rising incomes has been that sort of historical and cultural association with gold in those markets. So that's been a big change when it comes to retail demand. When it comes to institutional investment demand, I think the biggest change that I would point to is new channels of access, in particular physical gold ETFs, which were launched around about 2003, 2004. And that meant because of the structure of ETFs and the fact they're traded like an equity on an exchange, that meant that some institutional investors were able to, for the first time, to access the gold market. And then since then, we have seen on average, an uptick in interest from that sector. So if you look, for example, last year at the height of the COVID pandemic and the economic impact of the COVID pandemic, we actually saw 2 things. 1, record high gold price, but 2, partly driving that was record high inflows into physical gold ETFs by institutional investors. And the reason for that is the bigger driver of institutional interest in gold is actually market uncertainty. So when you have periods of high financial stress and market uncertainty, that's when you often see institutional interest in gold pick up. Another driver to think about as well, I'm sure we'll talk about this later, is inflation and also the interest rate outlook. But it's uncertainty that often drives institutional interest, which is why last year we saw significant interest from institutional investors. Conversely, and this goes back to what I was talking about, gold being a dual asset or having a dual nature, retail investment is not driven by economic uncertainty, but is driven by economic growth and economic confidence. So when consumers or consumer sentiment is picked up in terms of the economic outlook, that's when you see retail interest in gold pick up, which is why last year we had lots of uncertainty and not very much economic confidence. You saw institutional investment pick up, but retail investment fall. This year, it's kind of reversed so far this year. We published our year-to-date figures at the end of October. But what we've seen is that institutional interest has slowed down. We've seen modest net outflows from gold ETFs. But I would point us back to the very high base that we had last year with the record inflows into gold ETFs. But we've actually seen consumer demand start to pick up. So jewellery demand, for example, is up by about 33% globally year on year. And that's because many gold consuming markets have emerged from the worst of COVID. We've seen a lot of countries emerge, some of them quite recently, from the lockdowns, for example. But because of the combination of the lockdowns and economic activity starting to pick up again, that has supported consumer interest in gold. So to summarize, I think the big changes that we've seen, one, on the retail side, rising incomes has spurred gold demand at the retail level in markets across the world, but in particular in China and India. We've also seen digitization have an impact. So in many markets, you can now buy gold digitally. And by that, I mean the asset, the gold, it's still physical, but the way you access the markets, the way you buy gold is through a digital channel, for example, online, or even through online banking. Some banks, for example, offer gold accounts. That's been a big change that has had an impact on the retail market. And then on the institutional market, the big change has certainly been the launch and development of physical gold ETFs in the early 2000s.
Now, one of the things that has shaken up the market somewhat in the institutional space is the fact that the arrival or the recognition of Bitcoin as possibly a store of value among institutional investors. And you see that as part of a portfolio approach, some early adopting institutional investors starting to put their money in Bitcoin. Do you see Bitcoin as a threat, particularly from younger investors who perhaps don't have the legacy of feeling that gold is a store of value and a hedge against inflation? Because today, among younger investors in particular, there are a lot of other alternative assets that they are comfortable in investing in. It could be NFTs, it could be cryptos, or alternative assets like classic cars or watches.
Well, cryptocurrencies, they're playing an increased role. If they are a store of value, they're a pretty volatile store of value. But when it comes to the competition, I would say they're fundamentally different asset classes to gold. And I'll talk about the reasons why. But I do think there is work for us at the World Gold Council to do to help explain those differences, because they play very, very different roles in a portfolio. And it really goes back to the point I was making about the nature of demand for gold being very diverse, and the dual nature of gold, and the fact that you have different drivers. So some sources of demand are driven by uncertainty, some are driven by economic expansion, some are driven by a bit of both. You don't get that diversity of demand and the diversity of drivers for demand in other asset classes. And what that actually means is gold behaves very, very differently. And because it behaves differently to other asset classes, and that's reflected through its lack of correlation to many other asset classes, particularly in downturns, that means it's actually can be an effective diversifier. So actually there is an argument to make that if you are investing in cryptocurrencies, they're not without risk. You might want to think about offsetting some of that risk with an allocation to gold. So, really they can coexist. So there shouldn't be a competition because they play fundamentally different roles in a portfolio. I would also point out as well, obviously by definition, a cryptocurrency is not a physical asset. Gold is a physical asset. When you own it yourself outright, you don't have the credit risk, the same kind of counterparty risk. So it's very, very different risk profile. You also, with cryptocurrencies as well, they're new. The regulatory regime for the industry hasn't yet settled. So we're seeing different approaches in different markets. I mean, China, for example, has taken a very, very different approach to cryptocurrencies than here in Singapore. And globally, that regulatory regime hasn't yet settled. And that is another element of risk. There's certainly regulatory risk associated with that aspect of the market. But so they play different roles. But I would say for gold to remain relevant, particularly for the younger generation, it's essential that gold product providers, they look at digital channels of access, because that's how young people in particular, that's how they're consuming information, but it's also how they're executing financial transactions. So there's two things to be done here. We need to look at how we are educating consumers about the role that gold can play. And that's something that the World Gold Council is doing. I mentioned we've recently launched a series of mini documentaries, but we do a lot of online marketing work, and all of our research is available in very, very different forms and formats to appeal to different types of audiences and so on. But the product providers themselves, they need to ensure that they are maximizing the accessibility of the gold market, and maximizing potential access to gold through digital channels, because that's how consumers, particularly younger consumers, are executing transactions and navigating the financial market. And the industry has to evolve as that market, the wider financial market, evolves as well.
Now, Andrew, one thing that we must discuss, obviously, is Islamic finance and the role of gold. What is the Gold Council doing in that space?
Well, it's a very good question. We've done a lot of work on gold in Islamic finance. Gold, for centuries, has had a prominent role in the Islamic tradition. Where there was uncertainty, though, was contemporary gold products. So I mentioned online gold accounts. I've mentioned physical gold ETFs. We have things like gold certificate programs and so on. And there was a lack of clarity, if you like, on whether some of these products were compliant with Sharia rules for finance or not. So what the World Gold Council did is we worked with partners in Malaysia, Tansri, Dr. Mohammed Al Bakr and Damani Advisors, to help develop a Sharia standard for the gold market. So we did that back in 2014, 2015, 2016. And then we worked with them and launched it globally. So it was taken to IOFI, which is the accounting and auditing organization for Islamic finance institutions. It's based in Bahrain. They set global Sharia standards. In some markets, an IOFI standard is mandatory. So in the UAE, for example, you have to comply with an IOFI standard. In other markets, they're used as guidance. So Malaysia, for example, has national Sharia standards that the Security Commission and Bank Negara issue. But an IOFI standard, it is a global reference point, if you like, for the Islamic market. And the IOFI Sharia standard, which was developed in collaboration with the World Gold Council, that was launched back in 2016. So that did cover permissibility of gold ETFs, and it provides guidance on how such products and products can be structured in a Sharia compliant way. That hopefully gives confidence to the banks and institutions to develop Sharia compliant products, but also hopefully it gives confidence to consumers that actually these products are in fact permissible and Sharia compliant. So after the standard was launched, we worked with partners in Malaysia and in the Middle East as well to help develop new and innovative Sharia compliant gold products to appeal to this market. And that work continues. We've seen lots of innovation in Islamic finance. If you look at Turkey, for example, which has slightly different rules, but if you look at Turkey, it's a great example of the role that gold can play in the financial system more broadly. In fact, it's probably the best example, conventional finance and Islamic finance, of innovation when it comes to what banks can do and offer in terms of gold products to their consumers. So you have not just traditional gold accounts, but you have gold check systems, gold point systems, for example. You can withdraw gold from many ATMs in Turkey. You can bring gold to a bank for deposit into a bank account. There's gold sukuk there. So there's lots and lots of different types of gold products, which really maximizes gold's use in the financial system. So it's certainly a very interesting market to look at. And we've seen a lot of innovation in other markets as well, including in Malaysia, where we've seen Sharia compliant gold ETFs. We have Sharia compliant gold investment accounts offered by banks as well.
Now, Andrew, it's been a fascinating conversation. What is the outlook like for gold in 2022?
There are two things to look out for, and it goes back to gold's dual nature. So first of all, consumer demand. As I mentioned, that is driven primarily by economic expansion. And we would expect COVID had a huge impact because of the lockdowns, but also because of its impact on consumer sentiment. We'd expect that to continue to improve as markets continue to emerge from lockdowns. Vaccination rates have increased. Countries are starting to open up. I mean, it's great news last week with the Singapore Kale, for example, VTL. Yes. We'd expect a lot more of that to happen. And so that continuing opening up and resumption of economic activity, normalization of the economy, we're certainly not out of the woods yet or over the hill. It's still, it's still a hugely challenging global situation. But I think we can assume that next year is going to be a better year, and that we will start to thankfully emerge from the worst of COVID. That will likely support consumer sentiment and would potentially support consumer demand for gold next year. When it comes to institutional investment, different picture. Because the drivers are different. As I mentioned, often market uncertainty is a driver of institutional investment, but also inflation and interest rates as well. And at the moment, certainly in the shorter term, or for a lot of this year, for example, a lot of the focus has been on the interest rate outlook, and all eyes have been on the Fed and other major monetary authorities as well about where rates are going. That has an impact on gold in terms of the opportunity cost. But in the medium and longer term, inflation is likely to be top of mind in many people's considerations. And there's a lot of indication that we are entering into an inflationary stage. There's a debate about whether that will be persistent and sustained or it'll be transitory, but it's increasingly looking like it could be more persistent. And in that kind of environment, you will see an institutional interest in gold as a hedge against inflation. And we've actually published some research on gold's role as a hedge against inflation. It's on our website, goldhub.com. But on there as well, we look at gold's performance against other potential hedges of inflation as well, because there are others out there, and look at the differences and the role that gold can play in that environment. So that's something I would urge people to look at for more information about this. But I think the big story, to summarize, for institutional investors is going to be inflation and how we mitigate the impact of that. And that's where gold can play a role.
Andrew, thank you very much for your insights. It's been a fascinating conversation.
Thank you very much, Brian. It was a pleasure.
Now, we've been speaking to Andrew Naylor, the Regional CEO of the World Gold Council, on Biztech's Wealth Conversation show. This video will be on our various social media platforms as well as our website, www.biztech.asia. Please subscribe or like our various platforms. Thank you very much for tuning in.